Hello again. We are back for submodule 1.e. This module is centered on the discussion of the basic tool that accountants use, the accounting equation. For the rest of this section, we will talk about the basic accounting equation and its expanded form. We will also lengthily discuss the elements of financial statements as they relate to the accounting equation. So let's start. The basic accounting equation is represented by this formula. Assets is equal to the sum of the liabilities and equity. In accounting, the effect of every business transaction is analyzed keeping in mind that when recording each transaction, the equation should be kept in balance. That means that every business transaction should keep the equality of the assets and the sum of the liabilities and equity. But before we proceed with defining these three terms, it is important that we understand that the equity element can be affected, that is, can either be increased or decreased by its related elements. This leads us to the expanded form of the basic accounting equation. There are related elements that can either increase or decrease the equity. The equity element increases when there is capital investment by the owner or owners of the business. Conversely, a withdrawal of capital investment decreases equity. Also, equity increases when the business earns revenue and decreases whenever it incurs an expense. Please note that if we deduct expenses from our revenues, the resulting figure could either be a net income or net loss. A business operation yields a net income when the revenues exceed its expenses, and conversely, it incurs a net loss when its expenses exceed its revenues. In other words, net income increases equity and net loss decreases equity. Now again, before we define these three terms, it is important that we illustrate or describe the changes or the increases or decreases of these elements of the accounting equation by discussing their normal balance. To introduce an easy way of recalling the normal balance of the elements, assets, liabilities, and equity, we can draw a letter T to describe the two sides of the accounting equation. The left side is called the debit side, or abbreviated as DR, and the right side is the credit side, or abbreviated as CR. CR and DR are actually abbreviations for debere and credere, the Latin words from which debit and credit were coined. Let us keep in mind that the side on which the elements belong is the side where their increases are recorded. This side where the increases are recorded is called the normal balance of these elements. For example, when a business transaction resulted to an increase in asset, that increase in asset is recorded as a debit. Conversely, when that transaction resulted to a decrease in asset, that decrease in asset is recorded as credit. Needless to say, the normal balance of an asset is debit. Again, the normal balance of an asset is debit. Let us proceed to the liabilities. When a business transaction resulted to an increase in liability, that increase in liability is recorded as a credit. Conversely, when that transaction resulted to a decrease in liability, that decrease in liability is recorded as debit. Therefore, the normal balance of a liability is credit. Again, the normal balance of a liability is credit. Now we go to equity. Because liabilities is on the same side with equity, we can use the same logic that we use in discussing liabilities to determine the normal balance of equity. That is, when a business transaction resulted to an increase in equity, that increase in equity is recorded as a credit. Conversely, when that transaction resulted to a decrease in equity, the decrease in equity is recorded as debit. Needless to say, The normal balance of an equity is credit. Again, the normal balance of an equity is credit. Now let's discuss equity further. We said earlier that the equity's normal balance is credit. That is, where the transaction results in an increase in equity, it is recorded as credit. Otherwise, if the transaction results in a decrease in equity, it is recorded as debit. Using that logic, we can now determine the normal balances of the other elements related to equity, such as capital, withdrawal, revenue, and expense. Since capital and revenue increase equity, it follows that their normal balance is credit. On the other hand, since withdrawal and expenses decrease equity, therefore their normal balance is debit. They say that one key to good retention and recall is through learning by repetition. So let us recall. The normal balance of an element in the accounting equation is determined by which side its increases are recorded. In the matrix in the slide, we can see that increases in assets, withdrawal, and expense are recorded as debit, and therefore the normal balance of assets, withdrawal, and expense is debit. On the other hand, increases in liabilities, equity, capital, and revenue are recorded as credit, and therefore the normal balance of liabilities, equity, capital, and revenue is credit. Now, we are ready to define these factors in the accounting equation. Let us first discuss what an asset is. Assets simply refer to resources that a business owns or controls that has the potential to produce future economic benefits. Examples are cash, equipment, receivables, and intangible assets such as copyright, trademarks, etc. Let us expound the definition of an asset. For example, cash, if unrestricted, is a resource that a business owns, and it can be used to produce future economic benefits such that it can be used to purchase supplies, inventories, equipment, etc. Another example is a receivable. A receivable is controlled or owned by the business as it has the right to collect it, and it can restrict others from having the same right. A receivable has the potential to produce future economic benefits as the business collects it. In some cases, receivables can be sold to others, such as financial institutions, at a discounted amount. An equipment owned by the business is also an asset. As an asset, it has a service potential. For example, if that is a production equipment, it can be used in the manufacturing process. Or if that is a computer equipment, it can be used for administrative purposes. An asset can either be current or non-current. Current assets are short-term assets that a company expects to liquidate and spend in 1 year or less, while non-current assets are long-term investments that are not easy to liquidate and have an expected life of more than a year. Examples of current assets are cash, accounts receivables, inventories, supplies, etc. Examples of non-current assets are equipment, intangible assets, and the like. To avoid confusion, we call asset as a broad term to name that element in the accounting equation or in the financial statements, while its examples like cash, equipment, or receivables, we call them accounts or account titles. As discussed earlier, the normal balance of an asset is debit. When we say account, it is actually the basic summary device in accounting. It is a summary device because a separate account is maintained for each element that appears in the financial statements, and we use the same to record the increases, decreases, as well as the running balance of each element in the financial statements. Normally, An accounting entity has a list of its own accounts called the chart of accounts. If you are an accounting personnel who works in a particular company, you can just take a look at the company's chart of accounts to determine what account title to use when you record a transaction. I have provided you a sample list of asset, liability, and equity account titles, including a sample chart of accounts in Canvas so that you can familiarize yourselves with them. So we focus back our attention to the accounting equation, and now with liabilities. Liabilities simply refer to claims against the assets of the business or the existing debts and obligations of an entity. When we say obligation, that is an obligation to transfer an economic resource as a result of past event. For example, there is an obligation to transfer an economic resource such as cash or other types of assets because the business borrowed some money from its creditors. In some cases, especially service-oriented business, the rendering of services can extinguish an obligation. For example, a wedding planner who receives payment in advance incurs a liability from his or her clients. Once the wedding planner already rendered all necessary and agreed or contracted services, then his or her liability is extinguished. Like assets, liabilities can also be current or non-current. By simple distinction, current liabilities have credit period of less than 12 months. Non-current liabilities have longer repayment terms which exceed 12 months. Common examples of current liabilities are accounts payable, salaries payable, utilities payable, etc. While common examples of non-current liabilities are long-term loans or bonds payable, which basically have longer payment or credit terms that may last for a couple of years. As discussed earlier, the normal balance of a liability is credit. Now we proceed to equity. Equity is simply the residual interest in the assets of the business after deducting all of its liabilities. Equity may take several names depending on the form of business organization. That is, owner's equity for a proprietorship, partner's equity for partnership, and shareholders' equity for a corporation. As discussed earlier, owner's capital investment increases equity. Conversely, withdrawal of owner's investment decreases equity. Now we proceed with revenue. Revenues refer to increases in assets or decreases in liabilities that result in increases in equity other than those relating to capital contributions. For example, if we sold goods for cash, the transaction increased our asset in the form of cash. Or if we sold on account, the transaction increased our asset in the form of a receivable. On both occasions, we earned a revenue. How about decrease in liabilities? If you remember our revenue recognition principle in Module 1.d, it states that a revenue is recognized when earned, not when collected. We also said that the point where a revenue is considered earned is upon delivery of goods or when a service has already been rendered. So for example, we receive cash for goods that are to be delivered next month. At the time we receive the cash, we will record a liability, not a revenue. We record a liability because the receipt of cash gave rise to an obligation or a liability to deliver the goods next month. The following month, when the goods are already delivered, that is the time that we recognize our revenue. At that time, our obligation to deliver is also extinguished, hence our liability is decreased. Common types of revenue are sales, service income, professional fees, etc. How about expenses? We define expenses as decreases in assets or increases in liabilities that result in decreases in equity. That is, other than those relating to distributions to owners. The definition highlighted decreases in assets and increases in liabilities that decrease the equity. Let us give an example. For example, when cleaning supplies are consumed, that decreases our assets in the form of supplies, and therefore we recognize an expense called supplies expense. Another example, when we purchase insurance at the start of the year that will cover us for 12 months, we initially record that as an asset called prepaid insurance. After 1 month, a portion of that insurance cover already expired. That is, for 1 month. If we are going to prepare an income statement after 1 month, we should decrease our asset prepaid insurance for that 1 month portion, and that decrease in asset will be recorded as insurance expense. How about increase in liabilities? There are instances where as of the end of the accounting period, there are expenses that remains to be unpaid or unsettled. For example, when we receive our electricity bill in December 2021, but plans only to pay that in January of 2022, then as of December 2021, we should recognize that as utilities expense. And because it remained unpaid, we also recognize an increase in our liabilities in the form of utilities payable. Now that we are through with defining the elements of the financial statements as used in the accounting equation, let us now discuss briefly the common financial statements that accountants prepare. First is the statement of financial position, or commonly known as the balance sheet. The balance sheet shows the measures of financial position of the business, or the balances of its assets, liabilities, and equity. Notice the heading of the sample balance sheet in the slide. The balances shown in the statement of financial position is as at December 31, 2021. This means that the statement of financial position shows the balances of the accounts since the business started. Take note, since the business started, and its financial position until the reporting date indicated therein in the statement. Now let us consider the statement of comprehensive income, or known to many as income statement. The statement of comprehensive income basically reports the measures of financial performance, the revenues, and expenses. Notice the heading of the sample statement of comprehensive income in the slide. Unlike the statement of financial position, the balances shown in the statement of comprehensive income is for the period, or for the year ending December 31, 2021, as shown in our example. This means that the statement of comprehensive income measures the financial performance of the business for a certain period. In this case, if the business reports using a calendar year period, the statement of comprehensive income shows the net income earned by the business from January 1 to December 31, 2021. The statement of cash flows basically shows how the cash balance has changed from the last reporting period. It summarizes information about both the inflows or receipts and outflows of cash or payments from the different activities of the business, which basically can be classified into three: operating, investing, and financing activities. The statement of cash flows will be lengthily covered in Module 8. Now let us proceed to the statement of changes in equity. As the name suggests, this financial statement summarizes the changes in equity within a specified period. Please note that the changes in the equity section that eventually appears in the statement of financial position depends on the form of business organization. The three forms basically have the same format, only that in a partnership, the statement of changes in equity shows how was the net income divided among the partners. Unlike in a sole proprietorship, the net income basically accrues to the owner's equity. Why? Because it is owned by only one individual. In a corporation, the statement of changes in equity includes any distribution of dividends to the shareholders. That decreases equity. Last but not the least is the notes to financial statements. This statement is basically prepared in accordance with the full disclosure principle of accounting. This statement contains the basis for the preparation and presentation of the other financial statements, including the accounting policies adopted and other explanatory notes that aid in the understanding of the accounts and balances in the financial statements. Now that we are already familiar with the accounting concepts, we are now ready to do the nitty-gritty task of accounting. In the next module, we will lengthily discuss the accounting cycle by taking up one by one the process involved in the preparation of financial statements.